Good afternoon. Thanks for being here with me. It takes 10 things to make a company, regardless of size, really function well. You got to have a great team. You have to have a great product. You have to have great culture, vision. I won't go into all of them. But over the course of the last 4 or 5 years, I've probably had 150 different meetings with investors that want to buy into the OT cybersecurity space. And all 10 of those things that you need to run a company really well have to kind of get distilled into a PowerPoint presentation. And there's one particular slide that always gave me a lot of doubt. And it's a slide called a total addressable market. What investors want to do is they want to invest in an organization, a capability, a solution that when they put their dollars behind it, it's going to scale to the moon. And so what they're asking prior to their investment is how many different people, facilities, and organizations can I really move this product into? And today I'm going to ask you to come on a journey with me where I talk about why that was a very challenging slide for me. The total addressable market I knew coming from the asset owner world was not as big as everybody wants it to be. Asset owners don't buy products and services as fast as IT does. And so what started as a little bit of a doubt almost 7 years ago, that little angel on the top of my shoulder that was telling me that the total addressable market was not something that you should try to skim the truth on, has actually become one of the biggest things that I'm excited to talk to you about today. The OT cyber journey is longer, it's more expensive, and it's tougher than all of us thought it might have been. If you're an asset owner, it's sometimes tough out there. Organizational changes, budget cuts, different operational changes within your infrastructure may make your OT cyber journey longer than it really should be. For the product companies that are out there that raised a lot of capital, their journey has been really tough, as evident by the types of fundraisers that have been happening, as well as some of the reductions in force. And if you're an investor, this has been a really tough journey for you because you're still looking for the return on your investment. Why do all three of these different disparate groups have in common, and what are they all buying into? I'm going to take you on a journey on 3 myths that I believe are affecting our market, and if we don't make some significant changes soon, they can really start to dictate the next 5 years, just like they have the previous 5. Feedback loops exist in our teams, in our homes. They exist within every facet of our culture. Market size, how many different players can possibly buy cybersecurity solutions in this space? How often do they buy? How much do they buy? And who are the core buyers? And then finally, this notion that every software, hardware company that ever raises capital buys into is that if I land in one part of the organization, I will make it to the other parts. Take it from me, that is the way that different companies buy into a dream. But does it happen at the same rate in OT as it does in IT? And so these different myths I'm going to invite you to think about. And it all is about one big story. And how does it all fit together? Is that collectively, no matter if you're an investor, if you're an asset owner, or you're a product company, this is what, in my conversations on a regular basis with all of you, this is what the OT cyber market kind of feels like sometimes. Who's pushing the rock up the hill? Why is the hill so tough to traverse? Who's pulling? We're going to dive into each of these, and we're going to start with a feedback loop. Now, analysts serve an incredibly powerful role within any industry. For IT, they've been around for a long time, and in any other market segment, you'll find there are analysts out there that are doing really great work, providing documentation about what the market looks like, what the asset owners are asking for. And in a perfect world, I think all of us would agree this is how it goes. You've got an asset owner talks to a market analyst, talks about what the challenges they see on their roadmap, challenges with new products they need, challenges with maybe services they need. Those analysts create market documentation, which then are inevitably consumed by the investor market. The investor market then makes up its mind that markets exist based on demand, and they then provide capital to create a necessary supply. That supply is in the form of products and services, whether it's tech or whether it's software. And then inevitably those products make it to market, thereby reinforcing or changing the belief system that the overall asset owners have. This is how it really is designed to work. And in some cases, I think it works well. Being on a lot of the different shapes here myself, this is what it sort of feels like in OT. Everybody remember this game? Sally tells Johnny something. Johnny tells Maria something. Maria says something to Jose. And by the time it gets over to the first person, the entire sentence structure, the adjectives, the overall meaning of what was being said is different. And I think everybody can attest to being underwhelmed in some way, shape, or form when it comes to these data loops. Well, let's dive into these data loops and figure out what's really happening in OT. So the first is you have an asset owner talking to an analyst. And that asset owner is probably going to be submitting some sort of documentation on what they need, okay? Seems simple, right? Well, how many actual OT owners, or the people that are responsible at the facilities, or the people that are actually responsible for buying asset inventory solutions and vulnerability management and doing the actual risk assessments, are they the actual ones with the contract with the analyst? On the same thread, how many analysts actually have steel toes or hard hats in their office or in their wardrobe at home where they've actually been on a shop floor, they've opened up cabinets. They really do understand the core challenges of this particular market. I argue that there is actually a sub-segment of asset owner, and there is a sub-segment of analysts that actually should be talking to each other, and they rarely do. Funny story, I used to be an auditor, and I worked on behalf of different asset owners, but I never wore the asset owner hard hat because I didn't have an @assetowner.com email address because I wasn't an employee. I was on subcontract. So after years of doing assessments on behalf of the customer, it had a lot of scars walking in those facilities, having to ask for documentation here and there. The day that I became an employee at Shell, I put a Shell hard hat on, and it's like the seas parted the first facility that I walked into. They didn't know if I was the engineer that was going to pay for the drill string or if I was one of the guys from procurement. As soon as they saw that logo on the hard hat, they said, "This guy's the customer. Everybody get out of his way. You're so kind. You're so smart." The same thing's happening right now with feedback loops, is that you may have one asset owner that has 100 facilities in 37 different countries, and there might be 20 people talking to the analyst groups about what they need, but there's only 1 or 2 people at the asset owner themselves that are actually responsible for buying the products. And I do not believe that the right analyst even exists with the experience, and they're surely not talking to the right asset owners. If we get disguised just from the fact that an @assetowner.com email address is collaborating with us, we can get some skewed information. But it goes deeper. The next thing that happened is that the analysts produce documentation all of you have read, and the product companies, they take that as liquid gold, especially if you get on a list or you get on some sort of graph. And then what they do is that they put their own mark on it and they feed it back to the analyst, thereby confirming that, yes, I have a product that matches that asset owner's needs. Fair enough. It seems simple, and I think there's a symbiotic relationship there. But who else is involved? Well, that same thought process goes back to the investor. And this is where things get really dicey, because the investor is now got a decision to make that says there is a list of needs by the asset owner. It was confirmed by the analyst. The product company says that they match it. They're on this list, so they must match it. What are we going to do? We're going to throw money into this company. And this is the first time that the feedback loop is very, very at risk of influencing big decisions that all of us have to deal with. Because the real question is, how much money should go in to solve that one little problem? The next thing that happens, which is absolutely inevitable, is that the product company gets on a megaphone and goes back to the analyst and says, "Look at how much money I just made," thereby increasing or decreasing the core belief system of the analyst that there exists a market. That's the trigger. is that the number one thing that OT, quote, analysts have been looking at to validate their own belief systems about their own writings in a market is the amount of money that has been raised by investors who have never invested in OT and traditionally invest in IT. The amount of dollars that have flowed into product companies far exceeds the total addressable market that we need. But no one is stopping to say, do the investors have any understanding of who the real asset owner is? And do the analysts writing these documents really truly understand the core needs? And is the dollar amount that we're spending match the actual needs? I think this feedback loop is a necessary loop. But over the course of the past 5 years, the actual data that the analysts have been able to project is it's so skewed in a couple different ways that I think asset owners are the ones that lose the most. Inevitably, a small segment of the asset owner community is going to have to make decisions whether they like or whether they don't like the products. That is a natural, open market mechanism, and it's happening well. But what most people won't tell you is that some of the most expensive solutions that are out there are churning at the product company like crazy. And they're not landing and expanding at the rate they were, and they don't have the personnel to actually configure a lot of these solutions. And so I think we are in this year and next a consolidation period where a lot of asset owners, through this very unique feedback loop, are coming back to say, not sure that one really met my intent. So am I being too tough on the OT market? Am I being tough on analysts? I don't think so. I think part of this is just the natural mechanism that we have to move through as we try to build great companies, both at the product side and the asset owner side. But when you take a look at the number of IT articles online compared to OT, when you take a look at the number of IT analysts comparatively to OT, when you take a look at the number of IT anything compared to OT, it dwarfs it. So the real question that I'm going to pose is, should there even be an OT cyber market? One of the biggest talking points when I'm speaking with other product companies, sometimes analysts, but mostly investors and product companies, is, hey, who do you sell to? Do you sell to the CISO? Do you sell to the CIO? Do you sell to the ops manager? And one of the things that I think encourages a belief system that we are figuring out as a collective industry is you take 3 chemical companies, all of them blue chip, all of them relatively the same market cap, and all in the same subsectors on what they produce. And I guarantee you that you will find 3 different leadership structures, 3 different definitions of risk, 3 different definitions of what an assessment should be, and 3 different definitions of who should really own the responsibility of data, as well as maintenance, as well as purchasing of equipment to secure a facility. Is that a bad thing? I don't think so. I think it is what makes this industry so unique. Lateral entrants in this market are not going to help us. We have to build from within and train from within how this industry works. When you think about how dollars make it into a cybersecurity product or service company, you have to understand there's this thing called a J-curve. A company comes out and they say, I'm going to invest X amount, I want to invest X amount of dollars to build Y amount of solutions for Z amount of companies that are out there. And going back to my original statement, you can have a lot of different components of your business plan, but one is huge, and it is the number one, probably most determining factor of the number of dollars you're going to get, and that's called total addressable market. What you see on the screen right now is a no-kidding overview of some of the top analyst recommendations in the last 12 months that have followed investment rounds, because every time there's an investment round, somebody says that the market is X size and it's growing at Y annually. Can anybody tell me that there's any congruent belief system on how big the market is or how fast it's growing? In other words, it's all over the place. We have some people that think this is a $50 billion market. We have others that think it's a $250 billion market. You have tons of different integrators that sell a lot of different things, service companies that sell a lot of different things, and so OT becomes part of their go-to-market strategy. But how do we really say that that company is just OT and this one is just IT? The truth is that what analysts are giving as the annual growth rate is a misinterpretation of how big the market really is. And the downside of that is that the amount of capital that is going into the market is creating natural forces on pricing, is creating natural forces on revenue and purchases in general. And so from a bird's eye view, it becomes pretty apparent that the analysts are being fed by how much money is coming into the market, and how much money is coming into the market is being fed by the analysts. And in truth, none of them are really aligned on how big this market is. That's why a total addressable market slide in this market is hard to do. If we take it one step further and we say, okay, forget the fact that a lot of dollars have flowed in, forget the fact that tons of value has been derived from these products and services. Let's just talk about what kind of position these companies are in. Everything in blue up here is from the IT market. Some of those names you know. The pink ones are the darlings of your industry. Some of you work at these companies. I didn't put any names up. The purple ones are generally publicly owned companies with at least 5 to 10 billion in market cap that have OT on their website. And I put them on the fringe because there exist a lot of big companies that say they're in OT, but if you take a look at their overall P&L, I guarantee you it's less than 20, maybe less than 10% of their revenue is in OT. So are they really an OT company, or are they just sort of an IT company that said, we're going to do that too? The pink companies represent the largest players in our own space. And the one thing I want you to take away is that the OT is to IT what the earth is to the sun. There is a massive market in IT. And we know front-end operations, computer systems, it's easy to scale by how many employees I have. It's easy to scale by how many workstations and how many desktops and how many. But when you start looking at facilities and when you start looking at chemical plants, rigs, it starts to become a little bit smaller. And so what I did is this research helped me illuminate, even if we counted all the purple companies, which we know are not really true blue OT, and then we reverse engineered some valuations from what we know about the money that was raised in OT, what we start to see is that there really doesn't exist a home for these OT companies unless they either go public or they are purchased by IT companies. And the last 9 transactions that happened in the OT space were valued between 25 million and around 140 million. And they were purchased by industrial players. There's only been a few that were purchased by IT. And so the real question is that we've got these investors, we have these product companies. There's only 3 ways to grow a company. You can charge more per client, you can sell them more stuff, or you can get more clients. And with the amount of capital that was raised in 2021, $1.6 billion across a host of different companies, all of them sponsored here, wishing them all the best, but the bottom line is they raised a ton of capital in 2021 on this premise that we can go get a bunch of clients, we're gonna build new solutions, and we're gonna sell our existing clients more. Seems fair, right? Interest rates were pretty flat, it was easy to raise capital. What were the investors looking for in 22 and 23? Where were they looking to get their ROI? Every VC's dream is what is called a hockey stick slide. What we have is we have revenue on the left and we have time on the bottom. And over time, you are going to spend a certain amount of money and your revenue is going to be generally flat. But once you start to take off and the whole world adopts your product, this is the hockey stick slide that everybody wants. As we compare with real data on what traditional companies do over time is they grow at a slower rate. And then eventually, when you take a look at IT market, it usually has driven higher multiples in the market because it grows at a faster rate than the traditional market. So what I hypothesize OT companies did in the recent 2 to 3 years is they pitched something like this. They said, we're gonna grow some, we're going to flatten, we're going to grow some, we're going to flatten, we're going to grow some. That's called a land and expand. So they get their first couple clients, and then they expand through those clients with more revenue, and then they go get more clients, and it is a land and expand methodology. But if you take a look at who's raised capital, who hasn't raised capital, my gut, from personal experience speaking with CEOs and understanding this industry, is the red really indicates what's happened with these OT product companies. A lot of them came in with a product that did not get adopted, at least in their sector that they wanted, or they tried to move into another sector and they weren't successful. They pulled back on product dev and they switched more to services, which is, well, the asset owner's not really ready for this solution, so I'm going to do more services. Well, there's a lower multiple on that because it's not valued as high. It'll be very interesting which direction these OT companies go. But I stand with confidence stating that based on what I can see in the open market, and being in this market myself, is that regardless of the asset owner's value derived from the product, the land and expand methodology that was used to drive more dollars into the company from the investors was rooted in a miscalculation of the total addressable market and how quickly they would be expanding throughout that through a land and expand methodology. There are certain companies that do really well in this sector, and they don't do that well over here. There are certain companies that do really well with one product type, and they don't do well over here. And if you take a look at the M&A that's happening over the course of the last 12 months, the companies that are getting acquired the fastest are the ones with an extremely niche focus that are bought for strategic rather than top-line revenue value for a much larger company. In other words, take a look at the capital raised in 23 and 24. What's happening here? This is how it works. Investors put in dollars at a pre-money valuation that is generally based on a multiple of their revenue. If you take that amount of money and you divide it by about 0.3, that represents 30% of the post-money valuation. That post-money valuations has been in the 600s, the 800s, the billions for a lot of these companies that raised capital in 2021. What they do is they put in X amount of capital to drive 18 months of growth, and they usually raise more capital right after that, but they do so at a priced round, because this is how it works. The little guy who is a seed investor knows a Series A investor. That guy knows a Series B investor. That guy knows a Series C. And nobody puts in any money unless he already knows that his buddy can bail him out and grow at a higher, different valuation at the next phase. But at some point in the last 24 months, that chain broke. And that's why we don't see in 2023 an extension of the capital raised to a higher level. That's why we haven't seen a lot of priced rounds. What we have seen is we've seen companies do what is called an extension. They simply give out more shares 2 years later of the same shares that were sold previously. And that's not a bad thing. Companies have to raise more capital in a dilutive capacity all the time. The question is, that's a huge gap. We raised $1.6 billion in 2021, and we didn't follow it up in 2023. So that means either companies went out of business. Just take a second and think about the companies that are not at this conference that were here 2 years ago. Some companies went out of business because of this. They raised too much capital. They could not prove that the asset owners were pleased with the actual results. They didn't have the market traction. They couldn't raise capital again. Other companies are going profitable. That's what I predict is the next thing, is that there will be companies that state they are profitable, and the reason is they are looking for an exit, most likely in the public markets, because they know that the public market is going to be different. Now, if we think feedback loops are weird in OT, wait till you go public and you have a bunch of millennials on Robinhood. I mean, look, a couple companies in this space go public, I will buy. I'll be the first in line. I'll buy options on a call. But I'm also really concerned that we're missing the big picture. Let me tell you who I think gets it. Let's take a look at some other data points. I'm going to take a look at employment growth and revenue growth over the course of the last, I think, 2 years. So we've got public cyber companies, relatively flat. No surprise there. You've got industrials. Revenue growth is down a little bit, but employment growth is flat. We compared that to the actual GDP and labor force. We're starting to see a trend. Now, with the data that we had access to, we also took a look at IT. And not surprising, IT was down. And I'm also not surprised with the fact that OT kind of followed that same trend. You're saying, Ted, what in the world are you about to show me? Because all this makes sense. Everything is following the public markets. Well, I was even surprised when I kept looking for a diamond in the rough on what the data really says. And OEMs get it. They've been in this space for a long time. They have a lot of cash. They trade on a different multiple. And in the same period that all of our companies are in the other rooms have been having reduction in forces, these guys are growing. They have thousands of industrial clients, and whether they are in the infancy stage or whether they are in the adolescent stage of their cyber journey, they're the ones picking up all the companies. The problem is they don't pick up companies for $1 billion. The last 8 deals have been between 25 million and 125. That is a third of the average amount of capital raised by some of the industry juggernauts that we're working with. I don't showcase this to showcase any favoritism, but rather a belief system that a lot of the companies that we're buying into have been driving their revenues on a belief system that there would be this magical exit opportunity. And the only way that these companies are going to be able to survive and give something back to their limited partners is they're either going to start breaking up or they're going to find a way, maybe by Congress, maybe by fear, uncertainty, and doubt, to create new market players to buy solutions. And that's why it feels like this. For the product company, they're trying to push this ball up. For the asset owner who already doesn't have enough time, doesn't have enough budget, and doesn't have enough people, they're having to buy products that are increasing in price every day because the product companies selling them are being pushed by the investors to sell more. The liquidity in the market makes it tougher to do business. Investors are going to deploy capital that has a price tag on it, and it also has an expiration date. And it's usually about 18 months. So one of the reasons that it's been very tough is because we've put so much liquidity into this market. And that rocky, steep hill that we're climbing up is the durative nature of the OT markets. We don't buy every year. We buy on maintenance cycles. We don't buy unless it helps us maintain safe, reliable operations. The ball that I think we're all moving up is this OT market. And I think products and services are the ones pulling the market with the rope. Analysts are behind the ball. They can't even see where they're going, but they're pushing as hard as they can. And guess who's at the top? The investors are trying to pull us all in. But the asset owner doesn't buy based on giving a return to investors. The asset owner buys based on when that critical asset needs to be secured. And the one thing that is driving the whole market are this concept of valuations that are way too high. And it's forcing asset owners, whether you recognize it or not, to be put into a position to buy products that you must stand back and ask yourself, do I really need this? Do I need as many of them as you're saying I need? And I think that's an opportunity for this market. This concept that OT cybersecurity should be a market in of itself, I think is rooted in a core belief system that OT cyber is really a lot bigger than it is. And that these huge kinetic attacks should force us to change the way that we buy products and services. OT cyber should be a subsegment of revenue-oriented investments that are necessary to achieve safe, reliable uptime. Asset owners have people, they have systems, and they have processes. And within that entire sphere of influence, there is a maintenance cycle. And we collectively, as an industry, figured out how to put safety inside that circle without affecting profitability. without losing our shorts with billions of dollars in a market. And my belief system is that cyber should simply be the same. I don't know each of you. You don't know me. But as we collectively push that rock up the hill, know that even that I can't see you and that you can't see the person next to you, now is when we must bridge hands. Although we're getting tired and it's hard to get an OT cyber program off the ground, and it may be very hard to showcase value to your leadership, just know that although it may seem that storms lie ahead, if we put reason ahead of innovation, and we put safety, reliability, and profitability in that order ahead of our interests financially, then we can have safe, secure, and reliable operations. Thanks.